Welcome! I'm Kara Griffith, the President and CEO of Tax Analysts. Thank you for joining us today for what promises to be a very interesting discussion on the state and local tax deduction, what we all know as the SALT deduction. More specifically, on the $10,000 cap on SALT deductions that was imposed by the Tax Cuts and Jobs Act of 2017. Like many provisions of the TCJA, the cap expires at the end of 2025. So the next president and Congress will be spending lots of time debating whether to extend it, and if so, how. Today, we'll discuss the implications of that decision. Now, today's event is another in Tax Analyst series of public discussions that we call Taxing Issues. We launched this series as another way for tax analysts to encourage debate on tax issues. We've been bringing the tax community together with leading policymakers and experts for bipartisan discussions on the future of tax policy and administration. As always, we welcome your feedback on how we can make our webinars more useful, as well as your suggestions for future webinar topics. You can send your feedback and suggestions to events@taxanalyst.org. We also welcome your questions for today's event. Please use the chat feature to submit questions during the webinar. For our panel discussion, I will begin by asking a few questions, and then I will turn to questions from you, our audience, and I promise to get to as many of them as time permits. For those of you who would like CPE credit today, please be sure to participate in the program for at least 50 minutes and answer at least 3 of the polling questions that will appear throughout the webinar. They will appear on the right side of the viewing window above the comment section. To receive credit for your answers, you need to register with Pigeonhole, our interactive Q&A system, by providing your name and email. Also, please remain in the default viewing window because you won't be able to see the questions if you expand the program to full screen. The course materials, which were sent out in advance, are also available for downloading under the viewing window. And now, on to our topic today, the SALT cap. As I mentioned, the TCJA imposes a $10,000 cap on the amount of state and local taxes that taxpayers can deduct from their federal income taxes. The cap is in effect for tax years 2018 through 2025 for taxpayers, both single and married, who itemize their deductions. During the negotiations that produced the TCJA, the SALT cap served 2 purposes. First, it was a trade-off for a higher standard deduction, which the TCJA doubled, and second, it was a revenue raiser. Now, the SALT deduction has been around a lot longer than you may think. The first federal income tax, way back in 1861, when Lincoln was president, had only one deduction. And yes, it was the SALT deduction. That deduction returned when the income tax returned in 1894. And then after the 16th Amendment made the income tax fully constitutional, lawmakers again included the deduction in the next income tax. And while it's been modified over the years, it's remained in the tax code ever since. The deduction is seen to protect taxpayers from the full burden of state and local taxes. And by limiting it, the TCJA disproportionately penalized well-to-do taxpayers in high-tax states. In fact, this $10,000 cap represented one of the largest limitations that taxpayers ever put on the deduction. Now, the cap has not been entirely well-loved by lawmakers in either party. Almost immediately after the TCJA was passed, lawmakers from high-tax states began to propose changes to it, and then states created their own workarounds to appease taxpayers. The one popular workaround that the IRS approved involved pass-through businesses, which aren't subject to the $10,000 cap. Lots of states with income taxes are now allowing pass-throughs rather than their individual owners to pay their state and local taxes, take the full deduction for those taxes, and then pass that full deduction on to the individual owners. Pretty clever. Under the TCJA, the SALT cap expires at the end of calendar 2025 unless the next president and Congress keep it alive. As lawmakers decide what to do, they'll be debating such issues as the nation's fiscal health, the interests of state and local governments, and tax fairness. We'll see proposals that extend the cap as it is, cut it below or raise it above the $10,000 level, or eliminate it altogether. Now, whatever eventually happens, we'll be hearing a lot about the SALT deduction in the coming months. So to kick off our conversation today, we have an outstanding panel. First, we have Kathleen Wright. She's the director of the state and local program at the Golden Gate University School of Taxation. Next, we have Jim Wetzler. He's a former director at Deloitte who specialized in the resolution of state tax controversies. And finally, we have Nikki DeBay. She's a shareholder at Greenberg and Traurig and an expert on state tax policy and the legislative process. Well, first, I want to thank you for joining us today. I think this is going to be a very interesting discussion, and it is certainly incredibly relevant at this moment. So, Kathleen, can you kick off our conversation today with a little bit more background on the SALT deduction and the cap and sort of highlight the policy arguments both in favor of and against the cap?
Well, thank you, Kara, and welcome to all of the folks out there that are attending today. I add my comment that yes, this is a very hot topic and will be a very interesting discussion going forward. A little more background on the SALT cap and what has resulted in part of the difficulty that we have had, not only as practitioners, but also taxpayers, in dealing with this workaround, so to speak. Let me explain how the workaround actually functions by looking at an example. So it will illustrate the problem that I'm now addressing. This SALT cap, well, let me interject one side comment that when the cap was put in place, for people like myself, very middle income, I mean, I teach school. How much income can you make teaching school? The $10,000 cap in a state like California, which is where I am a resident and where I'm sitting right now in San Francisco, meant that essentially, if you worked and you owned property out here, you were subject to this cap. I mean, there's no doubt you lost deductions, and in many instances, very significant deductions. And therefore, the tax minds at work, practitioners, taxpayers, began to try to formulate ideas as to how to get around the $10,000 cap. Most of them were not successful, or they were just not popular. They didn't click. But one of them did, and that's the one introduced by Connecticut, which is what we're talking about today. So here's the way this one works. Let's take Joey, our hypothetical taxpayer, and assume that he gets $100,000 from the flow-through entity that he owns. Now, in California, the statutory rate for this workaround, and it is statutory, we don't use a rate schedule, is 9.3%. So with respect to this workaround, if Joey elects to use it, he would have his flow-through entity pay 9.3% of $100,000 or $9,300 on his behalf. And as Kara mentioned, because this is an entity, quote, a trade or business deduction, it would not be under the cap. And you go, well, that's less than $10,000. So what has he gained? Well, if he itemizes, he's freed up $9,300 to use towards property tax or other state income tax that he may have to pay. So there is a benefit. Now, what's going to flow through to Joey is $90,700, $100,000 minus $9,300. So when Joey then turns around to do his state tax return, he adds back the $9,300 because state and local tax is not deductible on the state return. So now we're back up to $100,000. And 9.3%, $9,300, Joey pays? No, that would be a double tax. Joey gets a credit from the state of California for $9,300 on his state return. Bottom line, it worked. Goes to the IRS, notice 2020-75, lo and behold, they agree, it works. And so all of a sudden, this workaround is born, and we have this remedy, if you can call it that, because you do have to have a flow-through entity in order to make this work. So the notice 2020-75 had a lot of issues related to it that were not addressed. There are issues related to the deduction. So here's where the complexity comes that we end up talking about today. You've got a federal return that's got to allow a deduction, and you've got a state return that's got to allow the same amount as a credit in order for the numbers to gel, flow the way they should, so to speak. To achieve that objective, there are issues with the deduction, accounting methods for one. There are issues with claiming a credit. Can you use it all? Is it refundable? Do you get a carry forward? And at the state side and at the federal side, how do you make this election? How do you make the wheels start to turn? And at the outset, I think just about everybody agrees nobody could figure out why the IRS approved this because there's 50 states out there. And if all of them do this, you're going to get a whole host of different procedures and processes that you're going to have to deal with. But Kara, that sort of sets the stage for talking in a little bit more depth about what these issues are and where we stand today.
Wonderful. Thank you so much. Jim, I want to turn to you. You recently wrote an article on this topic, and I will readily admit it was one of the reasons that we decided to do this panel, because you raised some really interesting questions, and you noted at the outset that this is a complicated issue. Now, for one, we've included your article as part of the material, so I encourage everyone to go and take a look at it. But can you talk a little bit about that and why and how this issue is as complicated as it is?
Well, the article deals not just with the workarounds that Kathleen mentioned, but all of the policy issues surrounding the SALT deduction. And the reason I wrote it was I was just dismayed by a lot of the public discussion I heard about this issue, whether it be on Twitter or in seminar rooms or in op-ed pieces. You know, the discussion seemed to very much oversimplify the problem. This is a very complicated issue. There are arguments on both sides of it, valid arguments on both sides of it. And so I thought I'd try to sort it out and encourage people to think more seriously about the substance of the issue. There are three reasons, I think, why it's a complicated issue. The first is that the SALT deduction is what might be called a hybrid deduction. It serves two purposes. One is to help better measure the taxpayer's ability to pay. After all, the whole point of an income tax is to scale tax burdens to people's ability to pay. And if you're forced to pay a tax to the state, you have less ability to pay federal tax than if you didn't have that burden. And you know, it's a little more complicated than that because you also receive services in exchange for your state taxes. So the services increase your ability to pay. So that's one aspect of it. The second aspect of it, it's a subsidy. The SALT deduction is a form of revenue sharing. It subsidizes state and local spending. And you can argue whether that's a good or a bad thing. There are arguments on both sides of that issue. That's one reason for the complexity. The second reason is that there are a lot of moving parts. You've got the structure of the SALT deduction. Is it a cap? Should the cap instead be a floor? Which taxes should you be able to deduct? You currently can't deduct, for example, the gasoline tax. That was repealed many years ago. Which taxes, you know, there's the alternative minimum tax, which has the effect of eliminating most, or in some cases, all of the tax, the benefit of the SALT deduction for people before the TCJA was enacted in 2017. It mainly affected people in the mid six-figure incomes, the upper middle class, the lower upper class. Now that's been moved up to the people in the low seven-figure incomes, but it takes away the benefit of the SALT deduction in a non-transparent way that was really never intended by the drafters of the alternative minimum tax back in 1978. I was on the staff then. I was involved in drafting it. Nobody gave any thought to the SALT deduction. There's the workarounds that Kathleen mentioned. There's the standard deduction. There's the tax rate schedule. Nobody's just going to restore the SALT deduction without also changing the rate schedule. There are the deductions for SALT in other taxes other than the personal income tax, estate and gift tax, business taxes. There's the PEAS limitation on itemized deductions, which was, you know, repealed by the TCJA, but springs back to life in 2026 if nothing's done. So there are a lot of moving parts, and the drafters are going to have to mesh all these different moving parts. They can't just focus solely on the SALT deduction. Then lastly, there's the politics. Almost everything that I think is good substance is bad politics in this area. And we can go into that in more detail later in the discussion, but you know, it's going to be a really difficult problem to do something that's politically feasible that also improves the substance of the status quo.
Yeah, you make a very good point on the politics, and I kind of look forward to digging into that a little farther, because this is going to be an issue where we're almost going to have to set politics aside and go with policy, but then you're going to have to look at the pay-fors and how are we going to do it all. So Nikki, let me turn over to you, and I sort of want to let you respond to both Jim and Kathleen and some of what they have said. I'm interested in your thoughts on the workarounds, the pass-through, also what other states explored that maybe didn't come to fruition, but what we might see in the future. But I also am curious about your thoughts on the policy of the SALT deduction in general, and sort of that pro and con of the deduction.
Yeah, so I'll start there and then kind of provide some other high level thoughts on just where we're at with these workarounds on a multi-state basis. So when the TCJA was passed in 2017, I will say that the SALT cap, personally, it was going to be challenging to deal with that, but I do focus on corporate taxpayers and large multi-state businesses. So this is not an issue that really was impacting the clients that I work with on a day-to-day basis. That said, and one of the things we talked about right at the outset was the SALT cap was one of the main reasons for it was to fill a revenue hole that was being created by some of the other items in the TCJA. So corporate rates were going down. There were several revenue raisers on the corporate side. And then on the personal income tax side, the cap was put in place to raise the standard deduction and to offset some rate reductions as well. And it was a very large number. I think the SALT cap was the first or second largest revenue raiser pay for in the TCJA. So it was a very important piece of that overall shift because they needed to make up revenue that was going to be lost in other areas. So on that hand, this becomes a very important issue for the clients I work with, because if this revenue that was supposed to be raised by the SALT cap doesn't come to fruition, and I think we're going to talk about that in a little bit as well, and the impact it does have on the pay for that it was expected to fill, what then are policymakers going to have to do to make up that revenue? And so I think that's going to be one of the political questions that Jim mentioned that will have to be grappled with. So those are from the vantage point that I was sitting at, some of the policy issues kind of on my radar. More or less just what will they do if this doesn't raise the revenue, and if there's an expiration or they're going to allow this to be repealed, what is that going to mean for the other taxpayers that benefited or the other benefits that were provided from the TCJA. So those are the things I see as the policy issues in play that I've been really paying attention to. With respect to the SALT cap workarounds and where we're at there, Kathleen was right. Connecticut was the first state to come out with this. I believe it was in 2019. So fairly quick turnaround from the passage of the TCJA. That was blessed by the IRS notice. And then, of course, we saw a flurry of states during 2020, 2021, and 2022 really acting quickly to pass these SALT cap workarounds, so known as pass-through entity taxes, the PTEs. And what do we, what could be better than a state tax issue where we have uniformity? No, we have no uniformity on this topic. So that, to this point of the complexities Jim's talking about, there are so many complexities when it comes to the SALT cap workaround. So we now have more than 30 states that have adopted these, and they work in all different ways. So I can't say that I've seen, one that has been completely replicated by another state. So the states have all put their unique twists on them. All of them are now elective. Connecticut initially was mandatory, but in 2022 they switched, or I'm sorry, 2023 they pulled that back, and theirs is now elective as well. So all the states that allow them, they are elective. Who has to elect them? So all the states differ here. Some states allow individual pass-through owner elections. Some states require all the owners to be in. Some states require that you have pieces of paper where all the owners have opted into this. So a lot of complexities around who can even be part of this or how to do it. The offset mechanisms differ from state to state. So many states do have the credit mechanism that Kathleen talked about, but there are some states that went with a deduction as opposed to a credit. So you just deduct that interest from your personal income tax. And then we have a very significant issue that's popped up late in the game here. But for the resident state that you are in, is that state going to allow the resident to take the credit for taxes paid in other states that were paid by the pass-through entity? And here we've seen states take differing views, and that, of course, will impact the overall desire or appeal of these and whether or not it makes sense for individuals. So the states have created a lot of complexity. And what are we going to do when this expires? We'll talk about that later. But this is just an area where, these are the types of tax issues that make me scratch my head and say, why are we making it so complicated? There has to be a better way. But there is a lot of money on the table for people. And this is a significant issue. So people wade through the complexities at the state level. And we'll talk more about how that is all going to shake out if this thing gets repealed.
So it's funny on why are we having to do this? It's sort of the next question I want, and I'll pose it to Jim, but I'd be interested in all of your thoughts on it. Any sense of why Treasury was willing to approve the workaround in the first place? It seems so counterintuitive because this was a revenue raiser. This was a pay for other things. I was very curious at the time when the pass-through workaround got the nod of Treasury. So Jim, I'll start with you. Any sense as to why this got blessed?
Well, I was just as surprised as you were. I was advising the New York governor on this issue during that time, and I said there's no chance that Treasury is going to approve this pass-through workaround. It's silly for New York to do it. You just got a lot of criticism, and then Treasury went ahead and approved it, and New York, rapidly moved to enact its workaround. In New York City did, I think, a year later. I don't have any real visibility into what Treasury was thinking. My speculation is that, first of all, to zap the workaround, Treasury would have had to adopt some kind of substance versus form analysis, and that would have created a lot of difficulty for the IRS because states could then modify their workarounds and inject just enough substance so that it passes muster. And so Treasury may have just made a judgment that the workaround was in fact valid under the then existing law. And if Congress wanted to deal with it, Congress meets every year, they could deal with it. There's no real pressure from Congress for Treasury to be tough on something like this. If Treasury fixes the problem, then Congress doesn't get to spend any money. If Congress fixes the problem with an amendment, then Congress scores revenue and can use that revenue for some other purpose if it wants to. So there's really not much. Small business, which is one of the major beneficiaries of the workarounds, is part of the Republican base. So I guess there were a variety of reasons why they were motivated not to do it. And I think it's easier to understand why once Biden won the election and the Democrats came and took control of Treasury, why they didn't fix it, because first of all, it would have violated Biden's $400,000 no tax pledge, and secondly, why should they anger a major Democratic constituency, high tax states, to fix a problem the Republicans created? Let them fix it. So I think there are a lot of reasons. It's not a big, it was a surprise to me, but in retrospect, maybe it shouldn't have been such a surprise.
Yeah, I mean, as you're talking about it, when you think through it logically, maybe it isn't such a surprise. It was just such an interesting, this was one way you got revenue, and now we're going to have to come up with a different way that we're paying for because we didn't. But I guess we'll get to play through that at the end of next year. Kathleen, I want to come to you. Do you think that the SALT cap has discouraged states in any way from levying other taxes, other higher taxes, or has the SALT cap changed tax policy in any measurable way?
Well, okay, of course, I'm out here in California, but with respect to lowering tax rates, let me explain briefly where the pressure was coming from, at least initially, and then whether that pressure had any effect on what California has done. First off, when the SALT cap was enacted and taxpayers started expressing their views very vocally, and they were very negative, Then President Trump's response was, well, if you're subject to the cap, then you're living in a state where the taxes are too high and the state ought to lower its taxes. And he said that multiple times. And then, so California, the highest tax, personal income tax, the highest rate in the nation, and sales tax, I don't think is the highest anymore, but it's up there. And so the reaction of California is, number one, are we going to lower rates? Well, no. Number two, I think as far as did this pressure put on state government to lower tax rates was not anywhere near the pressure that the state gets from multiple other sources. For several years, recently, several years, during the pandemic and whatnot, the states have been operating at a surplus. And in fact, the surplus was so high in California that it triggered something that we call, quote, the GAN limit, GANN, the GAN limit. It's legislation passed some time ago that says if your reserves get too high, in other words, if you collect too much of the way of taxes, you got to pay it back. And they did. They had to. They did. And so we were awash in revenue for a while there, but this year is a different story. Now we're looking at somewhere in the neighborhood of a $49 billion deficit. And the legislature has enacted a budget, presumably to cover the deficit. But in the context of now being back to normal and not getting all of the federal funding related to the pandemic, we see that what has affected California, at least, is outward migration and people leaving the state. And that's in many ways a first. New York, the same. And so the bottom line then is we're certainly not going to raise taxes to enhance or exacerbate that situation. And we really can't increase taxes when we're already the highest in the nation on the personal income tax rate. So I don't think that this cap has got that kind of significant political clout behind it. Does it have an audience? Sure. I mean, high net worth, middle income to high net worth taxpayers are somewhat affected by this. But I don't think that impact, I think the impact is going to be on Congress of the sentiment of taxpayers with respect to this cap, which is, and I'll conclude after this sentence, which is, I think, as Jim pointed out, why former President Trump said what he did. In other words, reversed his position so that the down ballot races in New York would have more opportunity for success.
Well, Karen, New York did raise its taxes on upper income people in 2021. It was a bit of an anomalous situation because, in ordinary circumstances, Andrew Cuomo, who's the governor then, would have made sure this thing never saw the light of day. But he was under a lot of pressure because of his sexual harassment scandal. He was on the verge of being impeached by the legislature, so he really couldn't stop it. I think we'll learn a lot in the next recession, which is when states normally have to start figuring out how to raise revenue, and to see if their response to the next recession is different than it's been in past recessions. There are a lot of people engaging in motivated reasoning at the states. The people who, defend high taxes on the rich basically believe there's no migration response, which is probably not very accurate. And the people who, defend the position of the rich say we're on the verge of a tipping point where if you raise taxes by a little bit, everybody's going to leave the state. The truth lies somewhere in between there, but we don't really know because we haven't lived with the cap long enough to see how it affects migration patterns. There have been too many other things happening in the last few years: COVID, work from home. All those things have a big effect on migration. It's hard to tease out the effect of taxation.
And I would add just, having a focus on the state legislatures. This was definitely not an issue that was being talked about by policymakers on the state level, except for the PTEs and workarounds. So I don't think, and I think Jim is spot on, that there were just too many things going on. All the ARPA funds, all the money that the states were receiving from the federal government was really helping subsidize the states on so many levels. And we saw states actually issuing refund and rebate checks to their citizens or their residents. We saw rates being cut, but that was, I never heard anybody linking a rate cut at the state level, those states that were cutting rates, to the salt cap. So really, this was an issue that I would say state policymakers are not very focused on, other than this, the PTEs where they saw, okay, we can help this group of people. And as Jim mentioned, in New York, they quickly moved once the IRS ruling came out. The states, it was kind of became a, well, why wouldn't we do that? And there was also a point before the Treasury ruling came out where the states were like, you know, they're going to decide it. We can offer this to our constituents. It's a great talking point in an election. So why wouldn't we do this? Why wouldn't we try to help our folks out? So, but I don't see this as the cap itself being something that they were focused on otherwise.
I think those are all really good points, and it was one thing, and the salt deduction for many years was just something you sort of took for granted. It was almost thought to be untouchable, and now we haven't lived with it for very long, with the cap for very long. It has been a short period of time, so it does become difficult to base behavior off of it one way or the other. Jim, I want to jump ahead just a little bit so we can kind of get into the politics of things. In your opinion, should the salt cap be extended? So if you're the one that's making the decision at the end of the day, would you extend the cap or would you do something different?
Well, I do something different. I think there's a lot of potential laws that you could draft that are better substantively than what they've got now. You have a very non-transparent law with the workarounds, the alternative minimum tax. They could reach some kind of compromise, in a simpler system. Let's say to compromise the interests of the high tax states and the low tax states. Maybe you deduct half the salt, half your deductions. I think there's one of the areas where the politics and the economics really diverge, I think, is with the property tax. There's not a very strong case for allowing a deduction of property tax. That should really be thought of as part of the homeowner tax preference. You don't pay tax on your imputed rent, what you pay in rent if you rented your home instead of owning it. And the tax base really should be, in a theoretical sense, the imputed rent minus the non-deductible expenses. When you allow a property tax deduction, you increase the homeowner tax preference. And most economists think the homeowner tax preference is not good policy. Politically, of course, the property tax is a lot of concern to the politicians in these suburban districts whose homeowners pay high property taxes and probably has more support than a salt deduction for income taxes does. But if it were me, I'd allow a deduction for state income taxes, but not for state property taxes. Maybe you can have a compromise, allow a deduction for half the taxes and get rid of the workarounds, and adjust rates accordingly so you're not ending up with a net tax cut on the rich. I mean, there are lots of things they could do. A lot of it will depend on just, whether there's divided government or whether there's, a unified government and, how the negotiations play out. There are a lot of possible outcomes here, I think.
Yeah, without a doubt. And a lot of it does depend on what the composition of Congress and the White House is, and how does that work together, and can some of, how much of this can be done through reconciliation. And it's going to be very interesting to look at. Nikki, if you're thinking in favor of the cap, are there ways that you can tighten the rules around the cap or tighten rules around the deduction that make it better? What, in your opinion, would be a better result?
Well, I was thinking about this because, and I just will say I'm not advocating for the cap to remain, but if we're going down that path, I think it's with the salt cap workarounds having been blessed by the IRS in this ruling. I think it's a very challenging issue at this point, because if the goal is to put in more guardrails around the salt cap to keep it at this low dollar threshold of $10,000. And if the goal is to actually make it the revenue raiser that it was supposed to be, and somehow limit the state's ability to allow these workarounds, we have a lot of potential preemption issues that the states are very much not going to be in favor of. And so I don't know exactly how this, Congress can undo what Treasury has done in a way that doesn't result in litigation and states saying you are infringing on our constitutional rights to impose taxes the way we want to. So I think there are a lot of challenges with that. The other question then becomes is, how does Treasury back away from, or would they back away from the ruling that is out there? So, and I don't know what the odds are of that, but I think trying to uh, Congress trying to legislate the pass-through entity workarounds out of existence, I think is a very tricky issue that we'll see if they can thread that needle. But and it's going to be very politically unpopular too, because it is, these have been in place. People have established systems to work with them, and so now is Congress going to come in and try to really say, no, the cap is the cap? So I don't I don't know how they do that at this point. I think the politics are very hard, and then there's just going to be difficult legal issues they think that will arise.
Well, Nikki, I don't think I agree with that. I think it's pretty easy for Congress to put the kibosh on the workarounds. All they have to do is take away the deduction for state and local taxes for businesses. There's going to be pressure to do that. If people want to argue about the corporate tax rate, one way to pay for a lower corporate tax rate is taking away the deduction for corporate state and local taxes. One way to pay for extension of the 20%, partnership pass-through tax reduction in Section 199A. One way to do that is to take away the deduction for state and local taxes at the business level. So I think I don't think it's a difficult technical problem for Congress to solve if they want to solve it, and they may well want to solve it as a non-transparent way of raising some money to pay for the lower corporate tax rate that they've enacted, or potentially future reductions in corporate tax rates, which Trump has proposed, or pay for extension of the 20% deduction for pass-throughs. So I think it's doable.
I'm not saying it's not doable. I think they're just going to get sued again. So I don't think the states are going to, as when the cap went into effect, the states sued the government saying, you have to provide this deduction. Those suits were not successful. But anytime the federal government tries to tinker with what the states are doing on the tax side, there will undoubtedly they will raise issues that they are not able to do that. And so, they've all passed these state laws that allow these pass-through entity taxes and these credits to operate, and so I think they would respond. So
I can't imagine it's going to be as smooth, and it's very politically unpopular then to say. So there would have to be a give and take there to me. If you're going to tell the businesses they can no longer deduct state and local taxes, there does seem like there would have to be some give there on the other side to get it politically passable. Kathleen, I want to get your thoughts on sort of the same topic of, in your opinion, should we extend the cap? And if so, how? And are there guardrails that can be put around it? And are there issues that would need to be addressed, whether by statute or by IRS regulation?
Okay. Well, let me address, I think, a question from you, Kara, that was just right there in the middle. If we do extend the SALT cap, are there issues that need to be addressed? And there are, both at the federal and the state level. Now, let me warn the audience out there. We now are going to get down in the weeds. And so here we go. First off, there's one that is unique to California. It would have been addressed if Senate Bill 1501 had passed. It did not. It died in the Assembly. And it is a very unfair limitation. And I'll describe it briefly because it's certainly unique to California, but here we go. You have to elect this. And as Nikki pointed out previously, now the elections are generally not mandatory. They are elections. And in California, it's always been that way. You either, and it's not only elective at the entity level, it is elective at the individual owner level. And so you have the partner, the shareholder, the member. making the election, and some of them can make the election, some of them cannot make the election. Now, hang on to that thought, because when we get to issues at the federal level, that's going to become very relevant. And so, with respect to, though, the election and state law, we have established June 15th here in California as almost as important a date as April the 15th or October the 15th or whatever date, filing date you want to look at. Because now there are several payments that are due on the date. And if you wanted to make the election, you had to prepay the amount of the tax, and the amount of the prepayment was the greater of 50%. Now, watch my words, of what you paid last year. Watch the date, June the 15th, or $1,000, the greater of the two. So we come up to June the 15th, 2024. So Nikki, let me ask you a question. Have all of your clients filed by June the 15th of 2024?
Happily, I don't do compliance anymore, but my sense is no, they definitely have not.
Right. And so we're talking about flow-through entities. We're talking about trades or businesses, and many of them, if not most of them, would probably be put on extension. So here you come up to June the 15th day. The amount of the payment that you have to make in order to make the election is 50% of whatever you paid last year, or $1,000, whichever is greater. And you don't even know what you paid, what you should have paid last year, because you haven't filed the return. And so there's that dilemma, coupled with the June the 15th, which is something of an odd date, and people just doesn't trigger practitioners. Yes, taxpayers, not necessarily. So the bottom line is, okay, what happens if you miss the date? Can you make the election? Answer, no. Categorically, no. That's it. No reasonable cause? No. No, amended return or something else? No. You cannot make the election. SB 1501 would have allowed you to make the election even if you passed the June the 15th date. There would be a penalty, there would be interest on the deficiency, but it would have cured this California created problem that's easy to fix, but it didn't pass. Not an uncommon story. So, Kara, that's one at the state level, but moving perhaps to the broader problems associated with extending the workarounds at the federal level, 2025, there's a major issue with S corporations. And with S corporations, if you apply it to the scenario that I painted for you a few moments ago, where some S corp shareholders make the election, some do not. Under California law, that's fine. That's the way the election works. It's totally an election. Now, if you do that, you have then what federal calls a constructive distribution to the shareholders of the S corp who made the election and now are having their state tax paid by the S corp. Now, S corps are unusual and difficult. They operate under a set of rules and restrictions that you must comply with throughout the life of the S corp, or your election is terminated. And it's just like that. And all of a sudden, you're a C corp. Now, that makes a dramatic difference in your tax filing processes and liabilities and so forth. And so with the S corp, one of the requirements is a single class of stock. And the way a single class of stock is measured or is analyzed under federal law is with respect to distributions. And that's why there's no special allocations at the S corp level, because they can't. They would violate the single class of stock requirement. Now, distributions typically pay out of money and so forth, but there's a concept of constructive distribution that is built into these rules. This tax payment by the entity on behalf of the shareholder would be, it's an example in the regulations, a constructive distribution, and therefore could violate the single class of stock requirement. And then the S corp isn't. Now, that same problem arises with the, not only, in the context of what I was just talking about, election or no election, but with resident, non-resident. Because if non-residents are allowed to make the election in California, and if they do make the election and the entity pays their tax, it's inevitably going to be a different rate than the rate that we use here in California. So you, again, have an asymmetric distribution scheme, which could also be viewed as a constructive distribution. That being the case with S corps, now this is only with S corps, but with S corps here in California, what we have said is if you want to make the election, everybody's got to be a resident, everybody's got to make the election. That's the only safe way to do it. And that obviously is discriminatory and a problem for a single type of entity and so forth. Let me move on to the second one quickly. And Jim and Nikki, I would both appreciate your input on this second one. It has come up as an issue out here, but let's have a go at it. Let's get to it. Investment partnerships. Now, yes, I've read Section 164, and I don't see the trade or business requirement under Section 164. And so, but let me explain what the issue is. With an investment partnership, the question, which has come up before in many other areas of the law, is this a trade or business? And you can argue this one both ways. And so the notice 2020-75 says that this workaround and deduction and so forth is allowed for a trade or business. Now, 164 is where you get at least the property tax deduction. And so does that necessitate a trade or business, or would investment type property also qualify? And the answer is it appears under 164, there's no requirement for a trade or business. So I just put that out there as an issue that it would be nice if the IRS clarified as to whether or not investment partnerships would also qualify for the election. Now I've got one more, but Jim or Nikki, do you want to jump in on that one?
I will just say, Kathleen, that is not an issue that I have heard any of the states, talking about
Right.
as they've been talking about these pass-through entity workaround issues. So that's I think that's so in the weeds. It's not quite on their radar. And I think to one of the points Jim made earlier, this just hasn't been around that long. So it's if the cap does get extended and we're going to remain in this world with PTEs for a significant period of time, I think those are the types of questions that are going to start coming up on audit and really being looked at by the states. But so far, California is way out ahead on many of the states on some of these.
It's a practitioner issue. It's talked about it here. Let's move on. Notice 2020-75 repeatedly says the deduction is allowed when it's paid. A lot of S corps are on the accrual method. Can you claim the deduction if you are accruing the expense and you haven't paid it until the following year? Most people out here, practitioners out here, are saying we better go with the notice. The language is clear. It says paid. We all know what that means. So let's not try to deduct it until the year wherein they pay it. That gives you an asymmetry between the year you claim the deduction, and see, we give a credit in California, and the year you claim the credit on the California return. Now, that's okay. It's just the numbers don't flow as easily as they did with the example that I gave at the outset because there's this mismatch. I mean, and then the mismatch keeps rolling forward. So it would be nice if that were further explained with respect to when it is based on the accounting method that you use that you can actually claim the deduction.
And on that score, Kathleen, most states have stuck with the payment. It has to be paid. So that does seem to be a line that the states have been pretty firm on in their application of the workarounds.
Nikki, I want to kind of keep with you for a second and ask, Kathleen was talking about a lot of what's happening in California. Do you have any sense of what the other high tax states, maybe in particular, are doing? Have you heard any word that they're looking ahead towards what is going to happen, whether the SALT cap is extended or whether it's eliminated?
Well, I mean, some of the states actually thought about this when they passed their legislation. There are definitely states that when they enacted their pass-through entity tax, there was also a clause in the legislation that said this will go away if the SALT cap is repealed. So some states definitely baked that into their legislation when they passed it. Other states and some of the conversations that have been happening at the national level amongst the states at the MTC and FTA meetings on this is I think there is a question about, okay, if the salt cap goes away, do we keep these pass-through entity taxes? And I think there are definitely states that have figured out how to impose the tax at the entity level, and it's created some administrative ease on their part because they're now just administering a tax on the entity for pass-through entities. There's significant questions raised by state administrators as to flow through entities and whether the states have resources to audit them and make sure they understand what these entities are doing and who's paying the right amount of tax. So there's a lot of skepticism when it comes to the states and pass-throughs generally. And so I do think there are some states that see the PTEs as maybe a way to just treat these guys more like corporate taxpayers, and that can help them with administration. So I think if the cap is extended, I hope that this is an issue that potentially the MTC would take up and discuss model legislation and to provide some greater uniformity. I think at this point, the states are thinking, well, if it's going to go away in 2025, why are we really going to do any tinkering at this point? This problem may just work itself out. So I think right now nobody's super focused one way or another. If the cap is extended, I would expect we would see a lot more states taking on efforts to fix issues like Kathleen just discussed, or we may see the states working together to create a little bit more uniformity when it comes to how the returns are going to be filed and whatnot. But right now, I don't. This is again, the states are just they've got other fish to fry currently. And, often they're pretty reactive on this stuff. This is also an issue where if the salt cap is extended, then the administrators are going to have to dig in and figure out what they maybe don't know or how to make some fixes. The policymakers aren't going to get involved. If the salt cap expires, then you're going to see some states where they didn't have this legislation that would kind of reverse course if it expired, they're going to have to figure out what to do, and that's going to have to go to policymakers. So maybe they just say we don't want to deal with it. We already did it, and the PTE remains, and people can choose to elect into it. Not sure if that's will still be something folks want to do, but some policymakers are going to have to deal with it, and I will just say state legislators don't always love getting into pass-through tax issues, and so we'll see how that goes. But I'm sure there'll be more discussions about this, and at the National Conference of State Legislators and some other organizations, the policymakers are going to have to start thinking about it.
Well, Nikki, I don't know. I think if for whatever reason there's a deadlock in Congress, the SALT cap expires and nothing's put in place to replace it, I would think the states would keep the pass-through entity tax workarounds because they still would get you out of the minimum tax, which affects a lot of taxpayers in the high tax states. So they'd be motivated to keep the workarounds, unless Congress does something.
Yeah, I mean, some of them are just
out.
going to go away though, because I mean, Oregon's a state where we definitely have a provision that says if the cap goes away, so does this entire regime. So then the legislature,
the legislature can always change that.
They can always change
the minimum
that.
taxpayers.
Yep. But I will just say, talking to these folks a lot, they don't kind of like get excited about pass-through entity tax issues if they don't have to. So I could see them going away.
It's hard. It's a hard topic. I don't think the IRS loves to have to deal with pass-through entity stuff either. So you can extrapolate that down. Jim, you mentioned the AMT. Before we run out of time here, can you talk briefly about what the relationship is between the SALT deduction and the AMT and why one matters for the other?
Well, sure. Basically the short answer is that the SALT has never been deductible under the AMT. And that really dates back to when the AMT was enacted back in 1978. And the goal of the AMT back then was not really to raise a lot of money. It was to, Senator Russell Long, who was chairman of the Finance Committee, was annoyed at reading these stories about how people had high adjusted gross incomes and didn't pay any income tax. And the only way to stop that was to, take away their itemized deductions. And so that's what the AMT did. But nobody expected it to raise very much revenue. There really wasn't any discussion of a SALT cap so salt deduction at that time. And then over the years, and that was 40 odd years ago. Over the years, the regular tax got indexed for inflation in 1981. The minimum tax was not indexed for inflation. So gradually the regular tax went down, stayed the same in real terms, while the AMT gradually went up in real terms because of bracket creep and inflation. And then Congress would several times enact tax cuts on the regular tax, but would not enact comparable cuts to the AMT. So more and more taxpayers gradually got moved onto the AMT until, by this century, you had a situation where in high tax states, almost everybody in the middle six-figure income brackets was paying AMT. And there was actually a little piece of the rate schedule where the AMT rate was actually higher than the regular tax rate, even if we had no deductions at all. So it's a very non-transparent way of increasing people's taxes, while pretending to cut them, or keep, it was, and that occurred over a period of years, and Congress was well aware of what was going on, and so, when they wrote the TCJA, they wanted to fix that problem by repealing the AMT entirely and simplifying the code. And that was very well intentioned, but they didn't quite make it. They needed a little bit of revenue. So they reinstated the AMT, but instead of having a rate structure that affects people at the six-figure income levels, it affects people now at the low seven-figure income levels. So it's the same, it would be the same problem, but now just for a different group of people.
Yeah, it's an interesting one. I don't know at the time, what do people hate more, the AMT or the SALT cap? It'll be a debate that maybe we have. So in our last few minutes, I want to give each of you an opportunity really to give your final thoughts on what do you expect in the next 6 to 12 months, and if there's a compromise to be had, what do you think that compromise is? Kathleen, I'll start with you.
Okay. Well, in light of former President Trump's most recent disclosure, and in light of the fact that Kamala Harris is from where I'm sitting right now, San Francisco, California, my thought is that there's a high probability that the SALT cap would not be extended, that it would be, that 2025 would be the end of it. But and then did you want me to go on to say, but what if it is extended? What should we do? Would be the compromise? The compromise, or a compromise that has been widely discussed, this is not new or novel, would be to increase the SALT cap limitation so that middle income are more or less exempted from the impact of this limitation. And then the elaborate workarounds that might be possible or not possible would be of interest primarily to very wealthy taxpayers. I don't know if that's a fair analysis, so to speak, but that would be, I think increasing the SALT limitation may be the easiest and with the most immediate impact on the audience that needs it, which is middle income taxpayers, solution.
Wonderful. Jim?
Well, I guess it's a lot just going to depend on what happens in the election. If you have a divided government, then my best guess as to what will happen is they won't be able to reach any kind of agreement. December 31st will arrive, and they'll just extend the existing law for a year or two and let some future election decide it. I think one thing you'll probably see, if what they do is want to change the level of the SALT cap, one thing I think they're likely to do is to fix the marriage penalty problem. Now it's $10,000 both for married couples and for singles. People don't like marriage penalties much these days, so I think they'd either go to a 5 and 10 if they want to tighten it, or they go to a 10 and 20 or some other number that deals with the marriage penalty. I'm not convinced that from the state's point of view, and you have states like New York and California that are highly dependent upon the taxes paid by upper income people. New York gets 40% of its income tax revenue from 0.3% of the population that make more than $1 million. And they really need a fight to protect that tax base. And I'm not sure there's a politically feasible solution that's any better than the workarounds. The workarounds have substantially reduced the pressure on out migration as arising of the SALT cap for both pass-throughs and people who set up family partnerships and put their investments in the family partnerships. You know, it just doesn't protect wage earners, but it protects these other groups. And I'm not sure the states, the high tax states, can get a better outcome than maintaining the workarounds. But we'll have to see. We'll have to see what happens after the election.
Nikki?
Yeah, I think there's a lot of question marks as to what will happen at the end of 2025. I think the path of least resistance is to just, they don't have to do anything and it would just go away. But I think we may see that happen, and then they come back in 2026 and say, "Oh wait, is this really what we want to do?" And maybe then there is some more of a middle road. But I think there's so many questions surrounding it, and are the workarounds really fair? They are. It is a fairly limited workaround. It only applies to pass-throughs at this point. Wage earners can't avail themselves to it. So I think we could see some additional fairness, regressivity arguments popping up. So it's hard to say what will happen, but I think we're going to have to deal with something, it seems like.
That's right. I think that's going to be the message of 2025, is that we have to deal with something. Well, I want to thank everyone for joining us today and for allowing us to run a little bit over time. I appreciate you all indulging us and watching, and I hope you all enjoyed. Have a great day.